All right. Hopefully you've had a chance to go through this example just to make sure you feel comfortable with all those new principles and constraints we talked about. So for each situation, you're going to say if the accounting method currently used by the company is correct or incorrect. If it's correct, what is it violating? What's been violated? And what should be used? All right, so here we have Heart Company. They are owed $10,000 from one of their customers. The customer is in financial distress and has provided evidence to Heart Company that it's not going to be able to pay the full amount, but only $6,500. Heart Company decides to present the receivable at the full $10,000. Now, I say you can always just trust your gut on this one. This one, you're like, that just does not seem right. So just go ahead and say incorrect. It doesn't seem right. And of course, there is a rule to back that up. Okay, so it violates the conservatism constraint, which is if we have two options, here's the 10K and the 6.5K, it says select the option, which one's it going to be, that's least likely to overstate assets. And accounts receivable, as we remember from last chapter, is an asset. Okay. Number 2, Lance Company is searching for real estate in order to build a new manufacturing plant. They end up buying some land for 48. The land was advertised at 50, appraised at 52. So the company is going to go ahead and record it at 52. So again, does that seem correct? It's not. It violates the cost principle, which says to record assets at the amount that you end up paying. So here they purchased for 48. That's what the land should be recorded at. Here we have an owner who owns 2 small businesses, and in preparing her financial statements, for one, she makes sure to keep all the transactions of the other separate. Woohoo, correct. Great work there, because that supports separate entity, the separate entity principle, also sometimes called the business entity principle. All right, here we have a winery. They have chosen to express their assets in barrels of wine instead of the dollar amount. No, that violates, that's incorrect. It violates that monetary measurement. Okay. Next, we have an individual. He is an owner, and he has decided to purchase a new vehicle for himself for personal use using company money. No, right? That violates separate entity. And let's see, you may have thought that one or more assumptions could be used, but go ahead and select the one that you thought was best illustrated, because we have some coming up where you're like, oh, it could be this or this. So we might differ a little bit. Let's see, we have Darte Inc. or Darte Company. They want to make their income look better. So they've added 2 more weeks to the year. No, that's wrong. They can't do that. Why? It violates the time principle assumption. Okay. Next one, we have a company, their largest supplier is in bankruptcy. And since the bankruptcy does not affect Mimi directly, they're not going to make any effort to communicate that. No, that violates full disclosure principle. All right. Next, we have a company who's reporting their inventory at the estimated value of 260 instead of 208. No, don't do that. Then here's one where you could have put different items. You might have said conservatism. You could have. But here we're actually going to go with cost principle. Why? Because what if the estimated value had been lower? What if the estimated value had been 200? We're going to talk about this one later in later chapters. But for now, they should record at cost, what they actually paid. Travis Company sells subscriptions to its online music service. Customers pay for access with the option for prepayment. Travis reports all payments as revenue, including prepayments. No, that violates revenue recognition, which says we have to earn it, in this case, provide the service in order to call it revenue. If they're prepaying for something, that's a service we're going to provide in the future. Okay, we haven't provided it yet. Therefore, we haven't earned it. That's what revenue recognition tells us. Here we have received a bill from our advertising agency for December, and we will pay it in January, and therefore we're going to record the expense in January. Nope. Expense recognition is violated here. Is violated. Remember, expense recognition or matching principle says to match the expense, so record the expense in the time period we got the benefit. So if we got a bill for December, they probably provided us work in December, therefore we need to record an expense in December. Jill Company has been in business, or Jilly Company has been in business for 30 years. They have lots of jobs scheduled for the upcoming years. But this year they've decided to present all their financial data at liquidation prices. No, that's not right. That would violate. Here, what I was going for was going concern. Going concern. We should assume the company is not in danger of going into bankruptcy, right? And especially I try to tell you they have a long history and they have jobs secured for their future. All right, hopefully you did good on that one.